A multi-trillion shift inside JPMorgan just changed the rules of credit in America. The scariest part is not the move, it is what forced it. Because in modern finance, the most dangerous warnings are not shouted, they are filed. No sirens, no emergency press conference, no dramatic headline that forces the public to pay attention. Just a quiet shift in posture inside the largest balance sheet in the United States, the kind of shift that only happens when the people closest to the plumbing of the system decide the risk has changed. And if that sounds abstract, let me make it personal immediately. If you have a savings account, if you have a mortgage, if you rely on credit cards to bridge the month, if you own a small business that depends on working capital, if you're building a retirement plan and assuming the system will stay normal, this is for you, because the next banking crisis will not start the way most people imagine. It will not begin with the front door of a giant bank getting chained shut. It begins with something quieter. Credit starts to disappear, not all at once, but just enough that ordinary life becomes harder in ways that seem unrelated. A loan approval takes longer than it used to. A credit limit stops rising. A refinance that should have been easy gets denied. A business line of credit gets reduced with a polite email and no explanation. A landlord raises rent because their financing costs rise. A job offer disappears because a company's borrowing suddenly becomes too expensive. None of those things arrive with a breaking news banner, but together they are how stress spreads through a credit economy. And that is why the biggest signal is not what JPMorgan says publicly, it is how JPMorgan positions privately. Because JPMorgan is not just a bank, it is the bank that expands when other banks break. When markets panic, regulators call JPMorgan because it is the institution built to survive chaos. It is a cornerstone of the system. It is the place money flows when fear rises. So when JPMorgan starts acting like a fortress, you do not ignore it. You ask one question: what does the fortress expect? Here's the first open loop. You are going to hear a lot of commentary about whether JPMorgan is safe. That is not the real story. JPMorgan is designed to be safe. The real story is why JPMorgan believes safety needs to be reinforced right now. Because there's only one reason a bank that profits from lending chooses liquidity and reserves over aggressive expansion. It believes losses are more likely than the public narrative suggests. Now, let us build the foundation carefully, because this is where the average viewer gets manipulated by noise. In January 2026, JPMorgan released its fourth quarter 2025 results. Reported net income was around $13 billion, and the firm highlighted strong performance in areas like payments and asset and wealth management. That sounds healthy. That is what headlines focus on. But buried in the same disclosures is a detail that matters more than any earnings headline. JPMorgan established a $2.2 billion credit reserve for the forward purchase commitment of the Apple credit card portfolio. Let me explain why that matters without hype. A credit reserve is the bank acknowledging expected losses before those losses visibly appear. It is not a press statement. It is a decision inside the balance sheet that says, we see risk, we are setting money aside now. And when a bank of this size does it, you should not read it as caution. You should read it as a signal. Here is the second open loop. If the biggest bank is preparing for losses, where are those losses likely to come from? And why are they likely to worsen? You already feel the answer in daily life. But you might not see it as a systemic story. It is debt, not just debt as a number. Debt is a fragile promise that only works when credit is easy, incomes are stable, and refinancing remains available. And right now, that promise is being tested from multiple directions at once. Let us start with consumers, because that is where the stress becomes visible first. Credit card balances in the United States reached about $1.23 trillion in the third quarter of 2025, a record level. At the same time, interest rates on revolving balances have remained extremely high by historical standards, meaning the cost of carrying debt is punishing even before job losses accelerate. So you have a simple equation: more people carrying more debt at higher interest rates with less room for error. In a world like that, you do not need a dramatic recession for delinquencies to rise. You only need the slow grind of higher costs and unstable income to keep squeezing. JPMorgan does not see this through surveys or headlines. JPMorgan sees it through payment behavior. Millions of transactions, real-time patterns, which people are paying in full, which people are paying the minimum, which people start paying late, which people stop paying entirely. That is why this bank is not simply a participant. It is a sensor network. So when it shifts posture, it is not guessing. It is reacting to data. Here's the third open loop. If JPMorgan sees consumer stress building, why does that matter for everyone else, even if you do not bank with JPMorgan? Because JPMorgan is not only a lender. It is a core node. It is one of the largest issuers in consumer credit. It is a massive payment infrastructure provider. It touches businesses, households, and markets in ways most people do not understand. So when it tightens risk, the financial environment tightens. Not because every bank copies JPMorgan out of respect, because JPMorgan is big enough to change conditions. Now we move to the second pressure point, commercial real estate. This is where the next phase of banking stress often hides, because it is less visible than consumer credit and it moves more slowly. A credit card delinquency can show up in weeks. A commercial loan problem can take quarters or years to fully surface, which makes it a perfect trap. Urban office markets have been reshaped by post-pandemic work patterns. Vacancies remain elevated in many areas. Refinancing risk rises when property values fall and interest rates remain high. Banks do not fail because one loan goes bad. They fail when a class of loans faces a refinancing wall at the same time. That is when defaults cluster. That is when reserves prove inadequate. That is when confidence breaks. You can think of commercial real estate like a slow-moving debt bomb. It does not explode in one day. It hisses for a long time, then suddenly triggers forced selling, write-downs, and capital pressure. And the public notices it only after the damage is obvious. Now, while this is happening, the third pressure point sits above everything like a ceiling. Government debt and interest costs. The United States has built a debt structure that assumes the world will keep absorbing treasuries at manageable yields, but when rates rise, servicing costs rise. And when servicing costs rise, fiscal flexibility shrinks. This matters because the entire system is built on the assumption that in crisis, the government will intervene. But intervention is not free. Every rescue is funded. Every rescue increases debt or expands central bank balance sheets or distorts markets further. So the system becomes dependent on a cycle. Crisis, rescue, larger system, larger debt, higher sensitivity. That cycle is why each crisis feels bigger than the last. It is also why the biggest banks keep getting bigger, because when the weak fail, the fortress buys the remains. That is exactly what happened after 2008. And it happened again during the regional bank stress in 2023. The system does not simplify after crises. It concentrates. So when you hear someone say, JPMorgan will be fine, they are probably correct. But that is not comforting. Because if JPMorgan is fine, it means the system will protect it. And if the system protects it, the costs are distributed to everyone else through tighter credit, slower growth, and a more fragile middle class. Now we arrive at the most important concept in this entire video. The crisis does not begin with failure. The crisis begins with tightening. It begins when the engines of credit start to slow. A credit economy is like a bicycle. It can remain upright only if it keeps moving. It needs new lending, refinancing, and liquidity to roll forward. When the wheels slow, the system becomes unstable. Here is what tightening looks like for normal people. You do not wake up to find your account frozen. You wake up to find life slightly harder. A car payment becomes more expensive. A mortgage approval requires more documentation. A business loan gets priced at a rate that makes expansion irrational. A landlord passes financing costs to tenants. A retailer cuts staff because customers are pulling back. A city delays projects because borrowing costs rise. No headline says credit is disappearing, but you feel it. Now here is the fourth open loop. Why does tightening happen before a crisis becomes visible, and why do people miss it every time? Because tightening is framed as prudence. Banks tighten quietly because it is socially acceptable. It is invisible. It is not controversial. Then, months later, when defaults rise, banks say, "We tightened because risk rose." The public thinks the tightening was a response to the crisis. But in reality, tightening is often the first phase of the crisis. It is the moment the financial system admits stress internally before it admits stress publicly. That is why you must watch the balance sheets, not the speeches. And that brings us to the Federal Reserve. In December 2025, the New York Fed announced that standing overnight repo operations would no longer have an aggregate operational limit, shifting to a full allotment format. Translated into plain English, the central bank made it easier for eligible counterparties to access short-term liquidity. On the surface, that sounds like a safety measure, and it is. But policy changes like this do not happen in a vacuum. The Fed does not remove operational limits because everyone is relaxed and confident. It does it because the Fed wants the system to be able to absorb stress without hesitation. It is pre-positioning liquidity. That is a clue. It does not mean collapses tomorrow. It means policymakers see conditions where liquidity demand could spike. And in finance, when liquidity demand spikes, the question becomes, who cannot get funding privately? Because that is where the crack begins. Now let us connect the story with a historical pattern that is extremely uncomfortable, because it reveals how crises actually form. Before 2008, the public narrative was optimistic. Housing was stable. Banks were profitable. Regulators were watching. And yet, inside the system, risk was being repositioned. In every crisis, there's a phase where insiders adjust before the public understands. Executives sell shares. Banks tighten lending. Risk is shifted, hedged, or reduced. Liquidity buffers rise. Reserves increase. Then the headlines arrive. The public thinks the crisis came out of nowhere. It did not. It was visible to those watching the right indicators. This is the psychological trap of modern life. People are trained to believe the news is the alarm system. But in finance, the alarm system is paperwork. Now we reach the fifth open loop. What is the single most dangerous moment in a banking cycle? It is not when a bank fails. It is when nobody trusts anyone enough to lend. That is what 2008 taught. Credit markets froze, not because every institution was insolvent, but because nobody knew which ones were insolvent. Uncertainty killed trust, trust killed lending, lending killed liquidity, and liquidity is the bloodstream. That is why confidence is binary. Either it exists or it does not. That is why even safe systems can unravel quickly when confidence breaks. We saw a modern preview of this dynamic in 2023, when bank runs accelerated through online transfers and social media panic, compressing what used to be a slow-moving process into hours. Technology did not make banking safer. It made banking faster. So now the system must maintain confidence in an environment where confidence can collapse at the speed of a rumor, which means the institutions closest to risk are going to behave defensively earlier, not later. Now, let us clarify something that many channels get wrong. This is not about predicting the exact year of a crisis. Serious strategists do not play fortune teller. They watch pressure. Crises do not follow a calendar. They follow a buildup. The trigger is unknowable. The vulnerability is measurable. And the vulnerability right now is simple. Debt levels are high across consumers, corporations, and government. Interest rates remain elevated relative to the previous decade. Refinancing becomes more difficult. Credit quality begins to fray. Liquidity is being pre-positioned by policymakers. The biggest bank is reinforcing its fortress posture. That is the setup. You cannot guarantee the spark, but you can see the gasoline. Now let us bring this back to you, because retention dies when macro stays abstract. What changes first for you is not panic. It is pricing. Credit becomes more expensive, not only because the Fed sets a policy rate, but because banks add risk premium. They decide the borrower is riskier, and they charge for it. That is why you can see an economy where the official narrative says things are resilient, yet ordinary people feel squeezed. Because the squeeze is not only inflation, it is credit, and credit touches everything. Now here's the practical reality that makes this frightening. Most people cannot simply opt out of the financial system. You still have to pay rent. You still have to buy food. You still have to plan for your future. You still have to participate. So the goal is not panic. The goal is positioning. The same thing JPMorgan is doing. Positioning means reducing fragility. If you are a household, fragility is high interest debt and zero reserves. If you are a business, fragility is depending on continuous refinancing with no cash buffer. If you are an investor, fragility is assuming growth multiples will stay high in a tightening environment. Positioning is boring. That is why people do not do it. But boring is how you survive. Now, I want to show you the part that most people find emotionally difficult because it feels unfair. Crises concentrate wealth. They do not distribute pain evenly. They reward those who enter with liquidity and punish those who enter with leverage. This is not moral judgment. It is mechanics. When credit contracts, assets get repriced. When assets get repriced, those with cash buy. When those with leverage are forced to sell, they sell at the worst time. When the dust settles, ownership becomes more concentrated. That is how the system works. And the reason it keeps happening is because people assume tomorrow will look like yesterday. But financial regimes change. The last decade was a regime of cheap money, a regime of low rates and abundant refinancing. That regime trained an entire generation to treat debt like oxygen. Now we are in a regime where debt is expensive and refinancing is uncertain. That regime punishes the habits that cheap money created. So the adjustment is not just economic. It is psychological. People have to unlearn the assumption that credit will always be available. Now let us close the loops one by one. First loop, what does the fortress expect? The fortress expects a higher probability of credit stress than the public narrative implies. Second loop, where do losses come from? Losses cluster where debt is highest and cash flow is weakest. Consumer revolving debt under high APRs, vulnerable commercial real estate segments, and corporate borrowers dependent on refinancing. Third loop, why does it matter if I do not bank with JPMorgan? Because JPMorgan is a system node. Its posture influences broader conditions and signals what sophisticated risk models see. Fourth loop, why does tightening come first? Because tightening is the internal admission of risk. The public sees it later as the economy slowing, but the credit system often starts the slowdown. Fifth loop, what is the most dangerous moment? When trust collapses and private funding markets freeze, forcing reliance on central bank backstops. Now, you might be asking, is this happening right now? We are not in a 2008 style freeze today, but we are in a pre-phase that looks familiar. Higher reserves, liquidity emphasis, tightening posture, rising debt costs, and policy pre-positioning. And that is exactly when preparation is most useful. Because when the crisis becomes obvious, the best options disappear. In a tightening cycle, the same thing happens every time. The safest borrowers get offers. The risky borrowers get rejected. The middle gets squeezed. That is why people feel confused. They do not feel like they did something wrong. They feel like the rules changed overnight. They did. They changed because the credit system changed its risk tolerance. And the largest institutions are always the first to adjust, because they have the data, the models, and the scars of history. So what should you watch over the next year if you want to be early instead of shocked? Watch consumer credit performance, delinquency and charge-off trends. Watch commercial real estate refinancing stress and bank exposure narratives. Watch corporate default rates and bankruptcy filings. Watch bank provisions and reserve builds. Watch central bank liquidity signals and facility usage. Those are the indicators that move before headlines, not stock prices, not political speeches, not optimistic forecasts, balance sheets. Because balance sheets are where truth is stored when people are afraid to speak it out loud. And that is why this matters. The most powerful bank in America is not panicking. It is positioning. It is reinforcing its fortress principles. It is recognizing the cost of risk. And it is preparing for an environment where liquidity matters more than growth. It is doing what the system always does before stress becomes public. It is quietly getting ready. And the uncomfortable lesson is this. The system will not warn you in a way that feels like a warning. It will warn you through friction, through tighter approvals, through higher rates, through shrinking credit lines, through policy changes that sound technical, through a slow shift in the rules of borrowing. By the time the average person hears the word crisis, the crisis will already have done its first round of damage. So you do not need fear. You need clarity. You need to recognize the pattern early enough to reduce fragility. Because in a credit-driven economy, fragility is what gets destroyed. And strength, even boring strength, is what survives. JPMorgan's move is not a prophecy, it is a posture. But when the biggest institution in the system changes posture, you pay attention. Because history is not made only by explosions. It is made by preparation, quietly, mechanically, and long before the headlines arrive.